There is a hidden mechanism running quietly beneath the global financial system, one so familiar that most people never question it, even as it extracts value from them every single day. You put your money in the bank, believing it's safe, believing you're being responsible, believing that saving is a discipline that protects you. Yet here's what nobody tells you. In the modern system, you now pay the bank to hold your money, not through a visible fee, but through a deeper transfer, one built into interest rates, inflation, and the architecture of debt that has grown to more than $19 trillion in the United States alone. This is where the pattern begins. Right now, in your financial present, the trap already surrounds you. Deposit accounts pay rates that lag far behind inflation. Your savings lose value every quarter. Your purchasing power erodes, and the institutions that hold your money use it to buy assets and earn returns that far exceed what they give you. Some economists argue that this mechanism is not accidental. It is the predictable consequence of decades of financial engineering that privileges borrowers over savers, debtors over depositors, and governments over citizens. But to understand how this system emerged, we must travel back to the era before the trap was constructed. In the 1980s, savers enjoyed interest rates of 8%, 10%, sometimes even 12%. Money in the bank grew faster than inflation. Debt was expensive. Saving was rewarded. Banks competed for deposits, and households building cash reserves could envision a path where time worked in their favor. Then the world changed. The 1990s brought globalization and financial liberalization. The early 2000s brought low-rate policy to stimulate growth and spending. And then came the pivotal transformation, the 2008 financial crisis, which revealed to policymakers that the entire modern economy was too fragile to sustain high interest rates. Debt levels were too large, markets were too sensitive, asset prices were too inflated. So they engineered a new era, ultra-low rates, quantitative easing, and a financial system that relied on perpetual borrowing. Here's what nobody tells you. Every time central banks cut rates, they shift power from savers to debtors. Governments with trillions in obligations benefit. Corporations rolling over their debt benefit. Banks writing loans benefit. But savers, the foundation of the old economic model, are left behind, punished for behaving responsibly. Let me show you exactly how the mechanism works. When the Federal Reserve lowers rates, banks follow. They reduce what they pay on deposits, often to near zero. Savers, lacking alternatives or fearing risk, leave their money in accounts that lose value each year. Meanwhile, banks use those same deposits to purchase bonds, finance loans, and earn yields far above what they pay depositors. Not interest, extraction. Not savings, subsidy. This is where the system flips. The bank does not pay you to hold your money. You pay the bank through lost purchasing power. And the beneficiary is not the institution itself alone, but the broader structure of debt that relies on cheap capital to survive. Here's why this matters. The U.S. government carries more than $19 trillion in marketable debt, much of it constantly rolling over. If interest rates were high enough to reward savers, the government could not afford its own obligations. Entire corporate sectors built on leverage would collapse. Real estate markets would buckle under refinancing pressure. Consumers dependent on credit would face impossible borrowing costs. Everyone thought low rates were a gift. They weren't. They were the price of keeping a debt-laden system afloat. At first, it looked like a miracle. Then the bill arrived. The bill arrived in the form of inflation, years when your savings earned less than 1%, while prices rose 4%, 7%, even 9%. Analysts suggest that during those inflationary spikes, the average household effectively paid banks and governments through negative real returns. You lost wealth. Institutions preserved theirs. Everyone thought they were safe. They weren't. The danger wasn't what they saw in statements, the steady number printed month after month. It was what they ignored, the shrinking value hidden behind that number. To see how deep this mechanism runs, consider the psychological dimension. People believe they are saving when they are actually subsidizing a system that punishes savings. They trust banks because they always have. They assume deposits are safe because the word savings implies protection. But the modern system rewrote the rules quietly, without ever announcing the shift. This is where the pattern begins to reveal itself clearly. Savers don't lose their money. They lose their time. They lose the years it took to earn those dollars. They lose the future buying power those dollars were supposed to represent. And the mechanism is so elegantly designed that it rarely produces outrage, only fatigue, confusion, and resignation. Let me show you exactly how the trap tightens. When inflation rises, banks often keep deposit rates low. This widens the gap between what they pay and what they earn. The wider the gap, the more profitable the system becomes for borrowers. Meanwhile, households trying to maintain savings must absorb the loss or seek riskier investments. This pushes them into markets they might not understand, exposing them to volatility. This is not savings. This is forced speculation, not prudence, pressure. The trap intensifies further when you examine how debt interacts with the system. Government debt requires constant refinancing. Corporate debt must roll over to avoid collapse. Consumer debt sustains spending that wages no longer support. All of it depends on low rates. All of it depends on savers accepting returns far below the rate of price increases. Here's what nobody tells you. The system needs savers to lose. If savers win, if they earn returns that outpace inflation, the entire structure cracks. Debt becomes unmanageable. Governments face fiscal crisis. Corporations face refinancing cliffs. Banks face margin compression. Everyone thought the economy was built on growth. It wasn't. It was built on debt. Trillions of dollars of debt that cannot function without extracting value from savers. This leads us to the emotional and financial chain reaction that now defines the modern system. Households save less. Banks pay less. Institutions borrow more. Governments depend on it. Markets inflate. Savings erode. Debt expands. And the cycle strengthens. At first, it seemed like a temporary adjustment in monetary policy. Then the pattern became permanent. This raises the central question that Section 2 must answer. If savers now pay the banking system through negative real returns, who truly benefits? And what happens when the pressure becomes too great to hide? Section 2 will reveal how the mechanism evolved, who gains from its continuation, who loses the most, and why analysts warn that the trap may soon reach its breaking point. Because the danger isn't in losing money. It's in losing the future your money was supposed to buy. The financial mechanism that forces savers to subsidize a debt-driven system is not static. It evolves, it adapts. It reshapes itself each time interest rates shift or markets break. Analysts studying modern monetary policy argue that the system now operates like a vast machine with one purpose: to preserve the solvency of the debt structure, even if doing so quietly sacrifices the people who place their money in banks. And the deeper you look, the clearer the pattern becomes. Here's the mechanism. Banks profit from the spread between what they pay depositors and what they earn on loans and securities. When deposit rates stay low while inflation and alternative yields rise, savers effectively transfer wealth to banks and borrowers. This spread isn't simply a feature of the system, it is the system. It's the foundation on which modern banking rests. The wider the spread, the stronger the machine becomes. The narrower the spread, the more vulnerable the system feels. To see how this evolved, we must examine the transformation of the last 2 decades. After the 2008 financial crisis, interest rates were pushed near zero. Central banks flooded the system with liquidity through quantitative easing. Governments issued trillions in new debt at historically low costs. Corporations refinanced, expanded, borrowed, and built entire business models around cheap capital. The world entered an era where time seemed to cost nothing and money seemed to grow on balance sheets rather than from labor. But here's what nobody tells you. This era came with a hidden cost. Savers, retirees, pensioners, and wage earners saw their returns collapse. Their savings grew slowly, if at all. This wasn't a side effect, it was a requirement. The system needed low returns to survive high debt. Then inflation returned. Inflation wasn't just a price problem, it was a structural threat. If inflation rises while interest rates stay low, savers lose purchasing power. If interest rates rise to fight inflation, borrowers suffer. Policymakers chose the path they believed would break the fewest pieces: raise interest rates aggressively, but allow banks to lag behind on deposit rates so they could maintain profitability and stability. Some economists argue that this strategy may have prevented a banking collapse in the short term, but pushed households into a deeper, long-term loss. As inflation surged above 8% while deposit rates languished around 0.05% to 0.5%, savers experienced some of the largest real losses in modern history. This is where the trap tightens. When depositors feel squeezed, they look for alternatives. They move money into money market funds, treasury bills, brokerage accounts, high-yield platforms. Banks respond by slowly increasing deposit rates, not enough to compete, but enough to delay outflows. But this adjustment raises banks' funding costs, and higher funding costs reduce their ability to lend profitably. This is the evolution of the mechanism. To preserve the debt structure, banks must protect their profit margins. To protect margins, they must underpay savers. And when savers flee, the system strains. Everyone thought the trap was temporary. They were wrong. The trap deepens when you look at who benefits most from the design. Governments benefit because low deposit rates keep their borrowing costs manageable. A government carrying $19 trillion in debt cannot afford high yields on savings or treasury securities for long. The math becomes unsustainable. Banks benefit because they earn money from the spread between deposits and loans. The lower they can keep deposit rates, the more they profit. Corporations benefit because debt remains cheaper than it would be in a system that rewards savers. Entire industries, from tech to real estate to manufacturing, depend on manageable borrowing costs. Asset holders benefit because cheap money inflates the value of stocks, bonds, and real estate. But who pays? Savers pay. Retirees pay. Young workers trying to build their first emergency fund pay. Anyone relying on wage income rather than asset income pays. Here's why this matters. The modern economy is bifurcating into two classes: those who own assets and those who hold cash. Those with assets gain purchasing power from inflation. Those with cash lose purchasing power because inflation erodes it faster than deposit rates replenish it. This is the hidden instability beneath the system. Let me show you exactly how this translates into the next stage of the trap. If high interest rates persist, savers will continue fleeing toward better yields. But this drains deposits from banks. Banks then respond by tightening credit, making loans harder to get, raising standards, shrinking balance sheets. This slows economic growth. Slow growth places pressure on borrowers who depend on loans for survival. If interest rates fall again, inflation may rise, eroding savings further. Savers lose once more. The debt system breathes easier, but households feel suffocated. Not growth, redistribution. The system redistributes wealth not by taking it directly, but by quietly allowing money to lose value faster than savers can earn it. Some analysts warn that if this pattern applies to the next decade, the greatest financial risk to ordinary citizens will not be job loss, market crashes, or recessions. It will be the slow bleed of purchasing power through negative real returns. This is the trap. Here's what nobody tells you. Negative real interest rates are not an accident. They are a strategy, a pressure valve, a mechanism governments use to shrink the real value of their own debt at the public's expense. Debt becomes cheaper when the currency becomes weaker. Savings become weaker when inflation outpaces interest, and the public absorbs the loss quietly. This brings us to the deeper evolution of the mechanism, the psychological anchoring that keeps savers in the system even when it harms them. People keep savings in banks because banks feel safe. They believe safety equals stability. They believe stability equals financial responsibility. But in a system wired to extract value from stagnant cash, stability becomes a slow drain. Everyone thought keeping money in the bank protected wealth. It didn't. It preserved the illusion of wealth. Now we reach the pivotal question, the one that determines the future of personal finance and the architecture of the modern economy. If the system requires savers to lose so debtors can survive, how long can the mechanism endure before savers revolt, withdraw, or restructure their financial behavior? Some economists argue that the system may adapt. Others warn of structural fragility if savers increasingly bypass banks. Others still predict a long-term drift toward digital alternatives, decentralized assets, or new financial vehicles that compete with traditional institutions. But all analysts agree on one thing. The existing system cannot survive without extraction. Here's the trap. Savers cannot win without destabilizing the architecture of debt, and the architecture of debt cannot survive without destabilizing savers. This is the contradiction at the heart of the modern financial world. It is elegant, it is efficient, and it is unsustainable. As we close this documentary, the truth becomes unavoidable, not dramatic, but quietly devastating. You don't pay banks by writing them a check. You pay them with time, with purchasing power, with the future your money was supposed to secure. And unless the system changes, or unless you change how you operate within it, the trap will continue tightening year after year, unnoticed by those who lose the most.